days late, 60 days late. They pay on time. FICO scores. Late. They caught up on their payments. Another 30 days late. LTV 95, LTV 90. They caught up on their 60 days late. Jesus, will fail. LTV 1.
So, this video is for Year 13 economists, and it's considering the financial crisis in 2008 and how it was caused and the impacts on the global economy. So I'm going to do it by the famous film The Big Short and use key scenes but with explanations. So as the quick introduction demonstrated with Christian Bale, the crisis was caused by the housing market and defaults on mortgages which rollercoasted into other financial portfolios. So, to provide understanding of the crisis, we need to really consider the political policies before the crisis and how deregulation within the banking industry set the fiasco up. So we've got Gordon Brown regulation via his light touch policy, and that was providing more freedom to banks, enabling more crossover with commercial and investment banking. And the reason why Gordon Brown did this was to allow London to compete with the likes of New York within the finance sector. And if we're considering America, America even had more lenient regulation than the UK did.
So is Morgan Stanley recruiting us? Is that?
Well, no. No, the bank owns our hedge fund, but we're not really a part of it. We invest in financial service companies, and we're trying to understand the residential mortgage business.
How many loans do you write each month?
About 60.
What was it 4 years ago?
10, maybe 15.
Yeah, I was a bartender. Now I own a boat.
You own a boat. So how many of these are adjustable rate mortgages?
Well, most. Yeah, I'd say about 90%. The bonuses on those skyrocketed a few years ago. Adjustables are bread and honey.
So do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck at my job.
Well, even if they have no money?
Well, my firm offers ninja loans. No income, no job. You know, I just leave the income section blank if I want. Corporate doesn't care. These people just want homes, you know, and they go with the flow.
Good for you.
Your companies don't verify.
If I write a loan on Friday afternoon, big bank is going to buy it by Monday lunch.
Yeah, same here.
Could you hold on a second? I don't get it. Why are they confessing?
They're not confessing.
They're bragging.
Do people have any idea what they are buying?
I focus on the immigrants, you know. Once they find out they're getting a home, they sign where you tell.
So, due to the lack of regulation, we saw lots of examples of the principal agent problem. Now, what the principal agent problem is whereas the principal has more information than the agent, and this was one example within the last video, whereas the mortgage broker selling the mortgages had much more information than people buying them, and was not providing enough risk assessment and financial guidance, and therefore people were acquiring mortgages, but these mortgages were very, very risky, and furthermore, the mortgage broker was then selling the mortgage on to other investment banks. So another example of asymmetrical information, and also an example of moral hazard, because these mortgage brokers, they knew that they were just selling these mortgages on straight away, so they would have to experience the repercussions, so they could literally act as unethical as they wanted to try and acquire as much commission from these deals. So these risky mortgages were then being packaged, and as I said before, being sold on to investment banks in the form of subprime mortgages.
Basically, Louis Ranieri's mortgage bonds were amazingly profitable for the big banks. They made billions and billions on their 2% fee they got for selling each of these bonds. But then they started running out of mortgages to put in them. After all, there are only so many homes and so many people with good enough jobs to buy them, right? So the banks started filling these bonds with riskier and riskier mortgages. Thank you, Banjo. That way, they can keep that profit machine churning, right? By the way, these risky mortgages are called subprime. So whenever you hear subprime,
So, as you can see from the graph, in the lead up to the crisis, there was an increase in subprime mortgages and a significant rise in the securitized ones. Now, what this means is that the mortgage loan does not belong to a single lender, and the loan is part of a pool earned by investors. Therefore, if this mortgage is defaulted, it can impact many investors. And if we think about just the rise in subprime mortgages up to if we go into here and onwards, where it peaked in 2006, just before obviously the bubble burst within the housing market, we can see the difference from before, you probably say 01, leading up to 07, how all of them, pretty much the majority of them, were securitized in terms of the value of these mortgage subprime loans. Now, these pooled assets were also known as collateralized debt obligations, in other words, CDOs, and many of these packages were becoming much lower quality and riskier due to the moral hazard that I mentioned before. As people were just trying to get as much commission as possible by selling risky mortgages and trying to increase the amount of subprime mortgages they were issuing, these CDOs were just getting packaged by, I suppose, really, really bad debt that would have probably had to have been written off, but people were buying them without understanding what actually was in these CDOs, and therefore we've got that principal agent problem again, and that asymmetrical information where the principal, the owners of these CDOs, were selling them on to investors, not really disclosing what was actually within them.
Well, here's Dr. Richard Thaler, father of behavioral economics, and Selena Gomez to explain.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. Bet you 50 million she wins, and I'll give you 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet. Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win, so I want a great payoff.
How about 20-1?
Deal.
And this will go on and on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
So, as the scene with Selena Gomez and Dr. Richard H. Thaler shows, the market for CDOs can continuously multiply into billions of dollars. It impacts across a range of different financial industries, even including the insurance industry, with companies such as AIG insuring against these CDOs in terms of credit default swaps. So therefore, when they did default, you can imagine how crippling it was for these insurance companies' liquidity, as they'd have had to have paid out on this. So, a CDO is usually divided into 3 tranches, each representing different risk levels. So as borrowers make payments on their mortgages, you can imagine this box fills up with cash. But once a threshold has been reached, such as, let's say, 60% of the month's commitment, the bottom tranche investors are permitted to withdraw their shares. Now, commitment levels such as 80% or 90% may be the thresholds for higher tranche investors to withdraw their shares. So you get, I suppose, different levels of risk within these tranches. However, these CDOs, they started to mutate into other portfolio packages, such as, for example, the CDO squared, which was mostly composed of middle tranches, or your multiple regular CDOs, or the CDO cubed, an even more complex package. And in other words, people didn't actually know what they were buying, as a lot of these tranches were actually being camouflaged. It was even possible to recycle some of the risky debt into something that's known as a AAA rated bond that were actually considered to be safe investment. But actually, if you broke it down and looked to see what was inside these bonds, they were going to be bad debt. They were very, very risky subprime loans.
All right, let's say you have a pool of 50 million in subprime loans. How much money could be out there betting on it in your synthetic CEOs and swaps right now, tonight?
Is it 50 million? $1 billion.
What?
If the mortgage bonds that Michael Burry discovered were the match,
How much bigger is the market for insuring mortgage bonds than actual mortgages?
about 20 times. If the mortgage bonds were the match, and the CDOs were the kerosene-soaked rags, then the synthetic CDO was the atomic bomb with the drunk president holding his finger over the button. It was at that moment, in that dumb restaurant with that stupid look on his face, that Mark Baum realized the whole world economy might collapse.
So subprime lenders offered consumers usually mortgages that carried low initial interest rates just for a short period, and that would, I suppose, entice them into wanting to acquire that mortgage. But once the initial specified period was over, the interest rates could jump quite considerably. And if that wasn't really pointed out to the person who was obviously buying or acquiring the loan and acquiring the mortgage, then it could cause a lot of difficulty. And monthly mortgage payments almost doubled in some parts of the US. And in most cases, when this happened, borrowers were actually better off defaulting on the mortgage loans rather than paying more for a house that had actually started to drop in value. And this is where we started to see the bubble, I suppose, bursting. And in 2010, it was reported that in the US there was 2.9 million property foreclosures just within that year.
The market's in an itsy-bitsy little gully right now. It's like everybody said, okay, that was crazy, let's just all calm down. I sold that house for $350 the year it was built. 2 years later, $480. Then $585 maybe 18 months ago. This couple bought it for $650 last year. He'd let it go for that. I don't. Will break his heart, but he'll let it go.
Why is he selling?
Neither one's working right now.
Orlean, you'd say they're motivated, right?
As motivated as one can be in this neighborhood. This house on the left, I'd say they're probably motivated.
Wow, a lot of people seem very motivated.
Oh, it's just the gully. That's all. Just nerves. So where do we stand?
I need to talk to my wife.
This market won't last.
Actually, could I talk to a mortgage broker? Anybody you recommend? Anybody you like?
Yes.
So when people were starting to default on these mortgage payments, debt wasn't being fulfilled and the housing market was falling in value, making it hard to recuperate the losses. This therefore meant that the value of, for example, these CDOs that we mentioned earlier, they were crumbling. Now, with regards to the UK, Gordon Brown admits he made a big mistake in deregulation, and he really underestimated how risk could be spread across different financial institutions in different countries, and didn't realise how intertwined the US and the UK market housing was. And as he said there, that was our mistake, but I'm afraid it was a mistake made by just about everybody who was in the regulatory business, hence why we experienced a global recession, and it wasn't just a US or a UK recession.
In the years that followed, hundreds of bankers and rating agencies executives went to jail. The SEC was completely overhauled, and Congress had no choice but to break up the big banks and regulate the mortgage and derivatives industries. Just kidding. Banks took the money the American people gave them and they used it to pay themselves huge bonuses and lobby the Congress to kill big reform. And then they blamed immigrants and poor people. And this time, even teachers. And when all was said and done, only one single banker went to jail. This poor schmuck, Kareem Sarah Geldin from Credit Suisse. he hit a few billion in mortgage bond losses, something most of the big banks did on a good day during the crisis.